Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. Taking a look today at the silver market, the silver ETF, and is silver finally short after what looks like perhaps a blow-off top in a big way on Friday? So let's jump in and take a look. First, we always like to, as we say, take a fusion approach where we're using fundamental, technical, and especially IV analysis to find that edge and then put on the head. So here is the IV chart. As you can see, here's Friday's just massive parabolic move to the upside here, going to by far the highest implied volatility of the past year. That's with silver hitting by far the highest level we have seen in a very long time. So the silver market certainly getting overextended on the implied volatility front. And like many of the commodity-based options, upside moves is where you see that jump in IV. With equity based, usually it's those big downside moves when the market has those crashes where you see the spike in implied volatility, where the VIX, which is the implied volatility of the S&P 500 stocks, shoots up. But you can see just a massive jump in implied volatility. Here it is from Thursday to Friday, Thursday in red, Friday in green. So just a huge lift in implied volatility. That means option prices are very expensive. Buyers willing to pay whatever to get in, many times a sign of short covering, right, as they're scrambling to protect perhaps their short silver position. Here you can see implied volatility now at 100%. That means option prices over the past 12 months have never been this expensive. Massive both call and put buying here. Sizzle index, a measure of kind of implied volatility and volume, certainly reaching an extreme as well. Here you can see that lift across the term structure volatility, the percentage move from Thursday to Friday in IV, massive indeed. Here it is on a more generalized basis, the 25 delta put and call. You can see trading very high, right? It had been down under 40 briefly, right? Kind of the mid 40s, then crept up, finally got through 50, got towards 60, and lo and behold, Friday with the huge move in SLV and silver, saw just that massive spike. You can see over here as well, just huge moves. And the trade I'm electing to go with is a put diagonal, buying the traditional January 16th puts, right? Selling the January 2nd puts. You can see decent term structure vol edge, buying an 81, selling over a 90. So do have a nice term structure vol edge on that one. When IV gets to this level, you absolutely want to include some options selling in your overall trade structure, right? Certainly selling out of the money call spread would work. The problem with that is you can many times get shaken out because who knows how high silver will fly before it does die. And we can take a look at implied volatility. Here it is over the past 6 months, taking a look at a basically slightly out of the money put and call 40 delta on each. You can see previous spikes, right, kind of leveled off right around that 50-ish area. But on Friday, we saw it shoot up well over 75. So implied volatility through the roof, no doubt. Looking for a reversion on IV, certainly, and also to take advantage of that, probably a drop in silver as well. Taking a look at the fundamentals, the one big fundamental is always the gold to silver ratio, right? Normally they tend to be somewhat correlated, right, with gold and silver moving up or down together. And you do get those divergences, right, where all of a sudden gold will dramatically outperform silver like this spike here, or silver will dramatically outperform gold like we have just seen recently. We are now under 60, right? So in other words, this is how many ounces of silver does it take to buy an ounce of gold? So under 60 ounces for the first time in the past decade have we seen this low of a level by far. The previous two instances when it dropped below 70, right? Forget 60, just below 70. Didn't last for too long, as you can see. And if you take a look, here's the chart of silver, right? Those two instances, right, prove to be significant short-term tops in silver, right? Did mark the high, ultimately had a pullback in silver as well. On the technical front, you can see the chart. Here's that gap and just huge jump up, right? We are now at the highest 9-day RSI over the past 12 months, well over 85, actually hitting 90, right? We're seeing MACD over 1 for the first time over the past 12 months. Bollinger percent B at 115, not quite the highest reading, but certainly close to it. And here's the generalized implied volatility, certainly at the highest level over the past 12 months. You can see the last time we saw IV spike like this, which kind of equates going back to this time frame here, right, where we saw that huge spike in implied volatility, did mark a significant short-term top in SLV. We saw RSI over 85, right? MACD not as high as it is now, but certainly at the highest level before just now over the past year, right? Bollinger percent B and IV high. So the trade we like is a put diagonal going out buying the January 16th traditional 68 puts, selling the shorter term Jan 2nd 67 puts, you know, paying somewhere around $2.30 or so. I actually put the trade on myself, paid $2.35, right? Silver continued to kind of really, and the short-term options actually popped a little bit higher, so that kind of hurt the spread, right? That spread narrowed as a function of term structure volatility, but you can see that we're able to sell about a 95 IV, selling those January 2nd 67 puts, and then our hedge buying the 68 puts that expire traditional Jan, right, are trading just under an 85 IV. So nice term structure vol, able to buy a cheaper vol by a large degree than we're selling. 13 is our negative theta by buying the ones out January 16th, right? But the short-term ones, because they're higher IV and further out of the money, have a higher theta. So basically, we make money as a function of time between now and next Friday for those to, you know, hopefully settle out right near the money would be ideal. This trade works perfectly if we move towards that 67 level. Basically, where it closed the day before on Thursday, right, would be the perfect price. Plus, we're leaning bearishly. We're selling a 27 delta, and that's somewhat inflated because of that high IV, right? And then buying our one that we're buying, the 68, right, able to buy a 36. So we're about 9 or 10 deltas net long, or net short, excuse me. So leaning bearishly. We're positive theta net about a dime a day. We're able to hedge off a lot of that IV that probably will fall here, right? And we also have the nice benefit of this trade structure, right? We have all these shorter term options, right? The SLVs have them 3 days a week as far as the expiration. So we have the 5th, the 7th, the 9th. They'll be coming out with more, the 12th. Before our 16th expires, so we have the ability to continue to chop wood, adjust. We're define risk, whatever we pay up front, that $2.35 initial net debit's our max loss here. And normally I would probably lean towards, you know, maybe selling out of the money call spread, right? But in this kind of move where you get so parabolic, right, and we've seen short squeezes in silver go to the moon. The Hunt brothers, obviously, the classic example, but you can't really time it that much. And being too early is the same as being wrong. So I prefer this kind of trade where you have a little more time. You know your max risk up front, right? You do with a call spread, right? But your risk reward payoff on this trade could be very nice, right? Especially if we move towards that 67 area over the coming week or so. So hopefully provide some insight how we go about identifying extremes, right, to take advantage of. It doesn't mean, right, that it's necessarily going to be a winning trade, because as we know, trading is all about probability, not certainty, right? So put the odds in your favor, position size accordingly, continue to hedge if need be, and get out if you're wrong. So until next time, as always, here's the